Good afternoon. Today we are having the lecture 6 of 779, and we will be covering all those factors which affect project cash flow. Besides this, we will also be dealing with different application of cash flows. If you remember, in the last lecture we had covered in detail the different aspects of project cash flow. In fact, we had solved one small problem also, and I had shown you how to draw project cash flow diagrams. Just to recapitulate what we had discussed in previous class, I will devote 2-3 minutes on it. There are few steps, systematic steps that are required to be done in order to complete the project cash flow diagram. First thing that we need to know is the bill of quantity. So, I had given you bill of quantity, rather extract of bill of quantity to start with. That was step 1. In step 2, I had given you the bar chart of that particular project. These bar charts can be derived from project network. Nowadays, most of the project management softwares are capable of converting a network into a bar chart. So, if you have got that output with you, that should be enough. The third information that we derived was, we had assumed the percentage progress of each of the activities, right. That was the third thing that we required. Then finally, we had noted down some important contract clauses, such as whether there is any mobilization advance, what is the retention money, at what interval mobilization advance is getting recovered, what is the total fraction of, what is the total cost for an item or for an item given the total value, all such things. Then further the breakup of total cost, like how much is the labor cost, how much is the material cost, how much is the subcontractor cost, what is the fraction of plant and machinery cost, and finally what is the overhead cost. So, with these informations we were able to draw the project cash inflow diagram and project cash outflow diagram. Now, the difference of these two diagrams I showed you that we said that this is the project net cash flow diagram or simply project cash flow diagram. So, this was what we discussed in previous lecture. In today's lecture, I am going to cover some of the factors which affect project cash flow. And besides this, we will also be covering the different utilities or different application of cash flows diagram. So, as you can note down, we will be covering two aspects in today's lecture. First, we will see what are the factors which affect project cash flow and what are the utilities of cash flow diagrams. Now, I will give you a summary of factors which affect the project cash flow. You can see it on your slide. Now, the project cash flow gets affected by many parameters. For example, if the contract has a provision for advances such as mobilization advance, it could be plant and equipment advance, it could be secured advance, which is nothing but the advances given for procuring the material. So, these are certain standard advances which owners normally give to the contractor. So, you will find that the provision of advances such as mobilization advance and other advances affects project cash flow in a big way, right. So, this is one factor. Then second factor is the margin. Margin is what is your profit on your cost. So, this also affects. If your margin is 10%, your project cash flow diagram would be somewhat different. If your margin is 15%, your project cash flow diagram would be different. If your margin is, let us say, 5%, it can affect project cash flow diagram in a different manner. So, these aspects we will be covering. We will take a fictitious example for each of these factors and then try to show you its impact on project cash flow. Then we will also see what is the impact of retention. Suppose you have got higher percentage of retention for your project, it may affect project cash flow. If you have got lower retention, it may have different impact, right. You must be aware of the fact that in lieu of cash retention these days, some contractors prefer bank guarantee, so that cash is not blocked. Liquid cash is available to the contractor all the time, and this eases the pressure on the contractor. So, some clients nowadays they also allow bank guarantee in lieu of cash retention. So, this aspect also we will be showing you through a fictitious example. Then what is the role of extra claim? Basically these claims arise on account of many factors, such as owners might have come up with some extra work, so there could be some extra claim for that, or maybe there could be some quantity variation. It could be either in plus side or it could be in minus side. That means quantity must have been either increasing or must have been decreasing in that particular project. Then another factor is, if you see the slide, it shows distribution of margin, such as front loading, back loading. These factors also play a role. We will see through an example how the project cash flow diagram gets affected due to uneven distribution of margin. There are three ways in which you can distribute the margin. It could be either on a uniform basis, or it could be on a front loading basis, or it could be on a back loading basis. We will see what are the impacts of these different kinds of loadings, such as uniform loading, front loading and back loading. Then there could be different mechanism of certification, such as it could be over measurement, under measurement. So, these things also play a role that we will shortly see. Then the important point, certification period. What is the time taken by the owner or his representative to clear your bills? That also plays a role. That is called certification period. You will find that if the certification period is quicker, let us say between 1 to 2 week time, you will have less problem of cash flows as far as contractor is concerned. Similarly, the last point of the slide, if you see, it talks of credit arrangement. Credit arrangement is basically the arrangement that you have with your vendor, with your labor supplier, with your equipment supplier, with your other subcontractors. So, depending on how much credit period you enjoy, it will have different kinds of impact on the project cash flow diagram. Now, we will take each one of these factors one by one, and then we will study the impact on the project cash flow. So, to start with, we will take the first point, that is advances. So, basically I am interested in what happens if in a project the provision of advance is there, and what happens in a project if the provision of advance is not there. So, that is what we are interested in studying. So, for this I am taking the same problem which I took it up in previous lecture. If you remember, we had got 13 activities. For each of the activities, I had given you the quantity as well as the unit rate quoted by the contractor. Now, in first case, what I have done is, I have assumed a mobilization advance of rupees 50 lakhs. In a second case, I have assumed that there is no mobilization advance, that is mobilization advance is 0. So, with these two informations, I have tried to capture the project cash flow for each of the month. So, if you see the first table of this particular slide, first column of this particular slide, you will find end of month. So, end of month 0, that means now, end of month 1, 2, 3, 4, 5, 6, 7, 8. So, this particular slide gives you the cash flow for each of the months up to 8 months for both the cases. One, when you have received mobilization advance, when I am talking of you, that means contractor has received a mobilization advance worth rupees 50 lakhs. The last column of this table will show you the figures corresponding to the situation in which as a contractor you have not received any mobilization advance. So, it is very clear in the end of month 0 itself. If you have received the mobilization advance, it gets reflected here. You can find 50 written over here. That means, as a contractor you have received rupees 50 lakhs. All these values are in lakhs. Yesterday I had explained you that 1 lakh is 100,000. So, when I say rupees 50 lakhs means 50 multiplied by 100,000. Now, if there is no mobilization advance, you can see the figures 0.00 appearing here. That means, the contractor has not received any mobilization advance at the beginning of the project. Now, based on the methodology what I explained to you in the previous lecture, you can calculate the month wise cash flow for each of these two cases. The first case, when you have received the mobilization advance of rupees 50 lakhs, in the second case when you have not received any money, right. So, this way you can continue working for the total duration of the project as well as the extended period when your retention money is to be submitted to you. So, if I go to next slide, you will find the data for the total period, end of month 9, end of month 10, end of month 11, 12, 13, 14, 15 and finally 16. So, you find that for the month 9 you have experienced a negative cash flow. That means, something is going, the resultant is going out of your pocket, whereas the same figure appears for the situation when you have not received any mobilization advance. Now, you can find the table completed in all respect for both these cases. Remember, these are the cumulative cash flow. So, that means, in the current month's cash flow I am adding the previous month's cash flow. This I am going on doing till the end of the project. In fact, beyond that also, till the time I am getting my retention money back from my owner. Now, this is what I have tried to capture it in a graphical form. So, the first graph shows the situation when you have received the mobilization advance. That means, when the contractor has received the mobilization advance, whereas the lowermost graph shows the situation of cumulative cash flow when there is no mobilization advance. So, you can clearly find the difference here. In the first case, that is when you have received the mobilization advance, you find that there is very few area which is lying in the negative side. That means, for a very short duration you will have to deal with the situation in which you have to bring money out of your own pocket. Whereas, for the second case, when the owners have not given you mobilization advance, what you find? You find that almost for the total duration of the project, you can see the negative area extending up to month 10. So, that means, for the entire project duration, you are facing liquidity problem. That means whatever money you require is to be brought in from your own sources. Now, when you are bringing money from your own sources, you are losing an opportunity to invest it in some other option. So, there lies the problem of negative cash flow. That is why you will find that most of the contractors, they try to persuade the owners to provide them mobilization advance. Now, you can understand the difference very clearly. If the owners have given you the mobilization advance, you are experiencing the negative cash flow for a very short duration. Whereas, if you have not received the mobilization advance, you are dealing with almost the entire project duration, a situation in which you have to invest your own money. If you have got money available with you, you can invest it from your own, on your own. If you do not have money with you, then you have to borrow it. Now, in both the cases, you have to lose certain interest. Now, the moment you are losing interest, this has to be booked into the project. Suppose you have lost X amount of money by way of financing it. Now, this X amount of money is not going to come from somewhere else. It has to be charged to the project, and ultimately it has to be borne by the owner, because this is the extra cost implication coming onto the project, which needs to be put in some head at the time of tendering, and then the same has to be got it from the owners. So, that is why even if in the project there is no mobilization advance, if you have carried out this calculation, you will be knowing the exact impact of financing that project, and accordingly you can load it in your bid prices and submit your bid. But if you have got the mobilization advance which is there in the contract, your life would be easier, because it is like working with the client's money right from day one. So, what in fact you are doing is, you are taking client's money itself to run your business, except for the short duration, in which, let us say for this problem from month 6 to 10, that means for about 4 months you have a slight negative cash flow, and that you have to manage either through your own money or through some loans on which you have to pay the interest charges. So, that is why you will find that mobilization advance has a major role to play as far as project cash flows are concerned. Now, we will move to some other factors, that is called margin. Now, margin is nothing but the contribution that you are getting from the project. After all, you are doing this particular business for earning money. Now, money from where you are getting? If whatever you are spending, you are recovering, it is fine, but you want some additional on top of your expenditure. So, that is what is called margin. So, basically it is defined as the excess over costs. So, basically it is the difference of the value that you have received and the cost that you have spent. So, basically the excess over costs. So, it is not very difficult to guess that higher is the margin in a project, better it is for contractors' cash flow. Higher margin means what? You must be doing it, you must have spent less cost and you are demanding more money from the owner. So, that is possible when you have put a higher margin in your project for each of the items. So, better margin means you will have better cash flow. That means, here again you are trying to extract maximum money from your owner to run the project. Now, this particular impact again we would like to show you through an example. So, for that I assume a fictitious project of 10 months duration. That means the project duration is 10 months. I further assume that rupees 100 which is cost in my example is incurred every month. These things you can note it down, the data for the problem. These data I am trying to utilize to show the impact of change in margin on project cash flow. So, for this I have assumed that I am going to incur rupees 100 every month for the next 10 months, which is the duration for the project. I am further assuming that margin is 10% of the cost. That means, if I have spent 100 rupees, I will be billing for 110 rupees, because 10 is my margin on rupees 100. That is what 10% margin on cost means. I am further assuming that the retention amount is 5% of the total bill value, gross bill value, and the whole retention money is to be released 6 months after practical completion. Let us say in this case 10 months. That means at the end of month 16, I am getting all my 5% back from my owner. This is just to simplify the real life problem. Now, it is also assumed that owner is delaying the payment by 1 month. That means, if I am submitting the bill for this particular month on, let us say, last day of the month, I will be getting the payment only in the next month, maybe at the end of next month. So, that means there is a clear gap of 1 month from the time I submit the bill and from the time I receive the bill, less all the retention part, right. So, these assumptions I have taken in order to show you the impact of variation in margin on project cash flow. Now, these are my base data. Now, from this, in another scenario, I will assume that retention amount is 10%, and then I will try to find out the project cash flow for each of the months. In another scenario, I will change the retention money to nil, that is 0%, and then I will see how does it impact the project cash flow. So, basically we are carrying out scenario analysis in which for the same set of problem, keeping everything constant, I am changing only the retention amount. In my base case or benchmark case, I am starting with 10% retention money. I will go on changing it to, I am starting with 5% of the retention money. I will go on changing it to 10% and then finally bring it to nil, 0%. Now, let us see how does it impact. So, you can see the table in front of you. The first row shows the months, month 1, 2, 3, 4, 5, 6, 7 up to month 10, and then finally 11, 15 and 16. There is a gap. So, I have drawn this table for 16 months, because 10 months is the project duration, and after 6 months of this duration, I am going to get my 100% retention money back from my owner. So, the second row of this table, you will find the information on cost. I had assumed that I am incurring rupees 100 every month. That means, for month 1 I have spent 100, month 2 I have spent 100, month 3 I have spent 100. Like this I have assumed up to month 10, because project duration is 10 months. Now, I have further assumed that margin is 10% of the cost. So, if 100 rupees is my cost, my margin is going to be rupees 10. So, this will also be there throughout the project duration. For month 1 it is 10, month 2 it is 10, month 3 it is 10, so on till month 10 it is again 10. So, cost plus margin becomes my gross bill or total value. So, you will find that the gross bill value becomes 110 for month 1, 110 for month 2, 110 for month 3 and so on up till month 10. So, these figures get repeated. This is just to simplify our calculation. I have assumed that I am incurring uniform cost throughout the project, I am getting a uniform margin throughout the project and hence my bill value is going to be same throughout the project. Now, I have assumed 5% retention value. That means, whatever bill I am submitting, my client is going to deduct 5% of it. Now, 5% of this works out to 5.5 lakhs, because 5% of 110 will be deducted by the owner from every bill, and after 6 months of the practical completion, that means at the end of month 16, he is going to give me all my retention money. So, what happens? How much is my bill which is due? This will be 110, which is my gross bill, minus 5.5, which is the retention amount. So, my net bill value is 110 minus 5.5 becomes 104.5. So, this figure continues right from month 1 to month 10. You will find the same figure getting repeated every month right from month 1 to month 10. Now, you must have recorded one more information which I gave you before starting this table. I had said that client delays the payment by 1 month. So, that means the payment which I was supposed to receive in month 1, I am receiving it in month 2. So, you will find there is a shift of 1 month. So, the first month's bill I am getting in month 2, second month bill I am getting in month 3, third month bill I am getting in month 4. So, month 10 bill I am getting it in month 11. So, you may find that there is a lateral shift of 1 month. So, what is your net cash flow for month 1? Your cost was how much? Rupees 100. As against that, how much money you have received? Nil. So, that means minus 100 is your cash flow. That means you have to arrange minus 100. That means 100 rupees you have to arrange for month 1. Come to month 2, you are getting a payment of 104.5. As against that, you have spent rupees 100. So, what is your net cash flow? It is 4.5 in plus side. That means your cash surplus as far as month 2 is concerned, because you are getting 104.5 from your owner and you are incurring only rupees 100. So, month 2 onwards you will find that your cash flow position improves. So, there was problem only in month 1. You have to borrow 100 rupees from somewhere. That is why it is coming in negative, minus 100 for month 1, for month 2 it is 4.5, which is plus, month 3 again it is plus 4.5, month 4 also it is 4.5, this continues till month 10, and finally you find that in month 11 you are receiving 104.5, but you have not spent even a single money. So, everything is coming coming in your pocket. And finally, at the end of month 16, you are getting the retention money also, that is equal to 55. Now, this type of analysis was performed for 2 more situations. In first situation, I increase the retention to 10%, keeping all other parameters same. In second situation, I reduce the retention money from 5% to nil, and I have made a comparative statement. This is shown in the next slide. Now, what you find when your margin is 5%, sorry, this when your retention is, just a minute. Okay, when your retention is, when your margin is 5%, you are getting a different cash flow. When you are getting a margin of 10%, we have already explained you, and when the margin is increased to 15%, another set of cash flow diagram is there for each of the months. This you can make a note of it and try to cross check at your own end, right. So, this is basically the impact of varying the margin percentage from initial 10% to 15% and then dropping it to 5%. So, we have taken 3 scenarios keeping everything same. In first case, which is shown in the middle of the table, that means third row of the table, or rather third column of the table, it is corresponding to 10% margin, keeping everything same. Now, in second column, I have reduced the margin from 10% to 5%. You find there is a different set of cash flow. At lower margin, you must notice here that we have all negative values coming up at least up to month 8. We will see what happens for remaining months. Whereas, if you have margin at 10%, only in month 1 you have negative value equal to minus 100. For remaining months, you have positive values 4.5, 4.5, 4.5 up to month 8. When the margin increases to 15%, you find that except for month 1, you have got positive cash flow higher in value when compared to 10%, and it is equal to 9.25%, rather 9.25 lakhs. Month 2, month 3, month 4 up to month 8. Now, for balance part, we will see how it appears. This is in continuation with the previous table. You find that for 5% margin, for month 9 and month 10, it is still showing negative values. Whereas, for 10%, as usual, it is showing plus 4.5, and whereas for 15% margin, it is showing 9.25. And finally, at the end of month 11, in first case, we are receiving 99.75. For 10%, we are getting 104.5, and for 15%, we are getting 109.25. And finally, at the end of month 16, here in this case, corresponding to 5% margin, we are receiving 52.5. For 10% margin, we are receiving 55, and for 15% margin, we are receiving a money of 57.5. So, what it shows? Higher the margin, better is your cash flow. Now, on top of it, if you have received mobilization advance also, it is further better. So, your cash flow position further improves. So, as a contractor, you should try to get mobilization advance as far as possible. Besides this, if you are competitive enough, you try to play with as much margin as possible. But there also you have to see by putting higher margin, are you still competitive? Because there is no point losing the job at the cost of very high margin. If market forces do not demand very high margin, then you have to recheck your strategy on margin part and put an appropriate margin, which will not only help you in winning the bid, but it also helps you in earning some money. After all, for that only a construction company operates, or for that matter any business house operates. So, we have covered 2 points. One was, rather we have covered 2 factors till now. One was mobilization advance and second was the impact of margin on project cash flow. Now, we will see some more factors and try to study their impact. With the same example, we will change data here and there, right. Now, we will study the retention part. Our objective is to find the impact of changes in retention on the project cash flow. So, here again we will try to work out with the base retention percentage, maybe 5% retention to start with, then we will change it to 10% and then finally to 0%. And then we will see how does project cash flow look like, whether by increasing the retention it is helping the contractor, whether by reducing the retention it is helping the contractor. All such scenarios we will try to decipher and then finally arrive at a conclusion. So, as you can notice in this particular slide, it says that retention tends to reduce the margin obtained from a project. How? Because the longer your own money is with the client, you are deprived of the opportunity to invest that somewhere else, in some investment option which is going to give you money. So, as a contractor you try to reduce the retention money, that is one thing, and then try to get the retention money released as quickly as possible. Because as you will see in this example, the longer is the retention duration, the more harmful impact it has on the contractor's cash flow. Similarly, you will also notice that the larger is the percentage retention, it has a very harmful effect on the project cash flow as far as contractor is concerned. Now, it is interesting to note that in case of very low margins, suppose you are quoting a project at let us say 2%, 3%, sometimes that is also done. If you find that market is having lot of competitions and you are not having enough jobs to keep your employees, to keep your plant and equipment in running condition. So, in such cases sometimes contractors do quote at a lesser margin. So, you will find that through your analysis that if you have got a job or you have got a project at very low margin and on top of it the contract has some retention clause, sometimes the effective margin may be even less than 0. The margin gets eroded. How? It gets compensated with the loss on interest, which you could have made had it not been with the owners. Now, you will also notice that the retention, if there is in the project, it affects the contractor's cash flow in a negative manner. That means, contractor has a problem if large percentage of retention money is recovered from every bill and it is kept with the owner for a longer period. Now, what we will do? We will take a fictitious example again and study the impact of change in retentions on the project cash flow. So, for this I will take the same example which we started with, in which I am assuming that 100 rupees is my cost every month for next 10 months, which is the project duration. Yes? Yeah? I am fast. Okay, I will be little slow in this. In this particular example, yes please. Now is it clear? Slides are clear to you? Technology class? Previous slide? This one? Okay, just note it down, and in the meantime I will also explain you what I told. Basically we discussed about the impact of retention on the project cash flow, and for this, similar to previous example, I am trying to vary the retention money or retention percentage and then trying to find its impact. For example, what would be the project cash flow if retention percentage is 5? What would happen to my project cash flow if retention percentage is 10? Again, what would happen to my project cash flow if my retention percentage is nil or 0? So, for this analysis, I will go back to the previous example, in which I assume that project duration is 10 months. Every month contractor is spending rupees 100, that means 100 for month 1, 100 for month 2, 100 for month 3 up to month 10. Then I will assume a margin of 10% on cost. So, my margin for first month would be 10, for second month also it would be 10, it will go on till month 10. So, if I add my cost and my margin, this gives me gross value of bill, which is for all the 10 months it would be equal to 100 plus 10, which would be 110. Now, I will assume in case 1 that my retention percentage is 5. So, month 1 the retention money would be 5% of 110, which will be equal to 5.5 lakhs. In second case, I will assume that there is no retention. So, that means whatever billing you have done, all money will be made available to you, but after a gap of 1 month, because we have assumed that client takes 1 month to release the payment. Now, in the last case, I will assume that retention percentage is 10. That means clients will keep 10% of 110 from every bill starting from month 1. So, this gets repeated for 10 months. And when are you getting your money back? After 6 months of practical completion. That means at the end of month 16. When the retention money is 5%, you will be getting back your 55 lakhs at the end of month 16. When the retention money is 10%, you will be getting paid 110 lakhs at the end of month 16. When there is no retention money, you won't get any money at the end of month 16. So, these 3 cases I have summarized it in this particular slide. Its title says summary of net cash flow for different margin. Rather, I will just make a slight correction for different retention. So, basically this table is showing you month wise cash flow for 3 conditions. When there is 0% retention, column 2, when there is 5% retention, column 3, and when there is 10% retention, last column. Now, remember that all these variations has been performed at 10% margin. So, in first case, for 10% margin I have assumed 0% retention. For second case I have assumed 10% margin but 5% retention. In third case I have assumed 10% margin and 10% retention. Now, you can note down these figures. For end of month 1, in all the 3 cases you are experiencing negative cash flow equal to minus 100. So, this is irrespective of retention percentage, you are getting the same value minus 100, minus 100, minus 100 for all the 3 cases. But when it comes to other months, month 2, month 3, month 4, month 5, month 6, month 7, month 8, you find the values are changing. When there is 0 retention, you find that for all these months you are having a positive cash flow equal to 10 lakhs. When you increase the retention money to 5%, your cash flow is still in positive, but in magnitude its values have come down. So, you can notice from 10 now you are receiving 4.5, and when it comes to 10% of retention, you find that all these months you are having a negative cash flow equal to minus 1 lakh. So, this is what I want you to notice, that higher the retention value, adverse is the impact on the contractor's cash flow. So, in a project if there is no retention, it is very happy situation for the contractor. If very high figure of retention money, it is a very grim situation for contractor, because he will be experiencing negative cash flow right from day 1, because most of his money is with the client which is sitting idle. It is not earning any money for the contractor, but if that money would have been with the contractor, he would have invested it somewhere else. He would have earned money on that, through that money also. So, this is the point that you have to note, that higher retention percentage is a bad situation for a contractor. Now, I will give you the remaining part of this table for balance months. So, this is showing you from month 9 to month 16. Again for 3 conditions: 0% retention, 5% retention and 10% retention. Now, for 0%, the happy situation continues throughout. Even for 5% retention, happy situation continues, but situation is not that happy when there was 0% retention. But when it comes to 10% retention, situation is still the same. We have a negative cash flow for month 9 and for month 10 as well. When there is no retention, 0% retention, month 16 you find that you have received 0 money from client because client had not recovered any money from your bill. When it is 5% retention, owners will pay you 55 lakhs at the end of month 16, and when it is 10%, owners will pay you 110 lakhs at the end of 16 months. Remember, all these calculations we had performed at a constant margin percentage, which in this case we had taken as 10%. So, for same set of data, we changed only the retention percentage and then found its impact on the cash flow. And our observations are, rather our conclusions are that lower the retention percentage, better it is for the contractor. Higher the retention percentage, situation is bad for the contractor. Now, we will move to some other factors. Extra claim. Now, extra claim contractors put due to many reasons. One obvious reason could be the change order. It may so happen that the owners might have desired something at the beginning of the project, and as the project progresses, he might have changed his desire in some of the items. He might have gone in for higher specifications or better specifications, or there must have been some change in quantity. It could be either in positive side, that means increase in quantity, or it could be the decrease in quantity. So, there could be many possible reasons for extra claim. Sometimes the owners may not have supplied the material in time, so the contractors are ready with the claim, right. Now, all these things you will find that when it goes for settlement, it takes time. What will happen? Suppose you have done some extra work worth rupees 5 lakhs. Now, you have already spent the money for executing that extra work, but when it goes for approval of client, you find that settlement takes usually very high time when compared to normal items, normal certification. So, there is a loss in interest, loss of interest by the contractor for the said amount. Suppose this claim has taken 6 months time to settle. So, who is the loser? Contractor is the loser, because the money which he should have got in month 1, let us say, he is receiving only in month 7. So, you will find that it causes negative impact in general. Although at the end of it, it may be a happy situation, the clients must have acceded to your request and you must have received the money. At the end of the project, your margin must have improved, but it is detrimental for contractor as far as his cash flows are concerned, because you will find that invariably extra claims take longer than any regular items to settle down. So, this puts added pressure on the contractor, because this thing he may not have forecasted at the beginning, but due to the pressure from client, he has to do these things. Now, naturally, when he is executing these additional items, he is incurring extra money. This extra money he had not accounted for in the beginning. So, it is putting additional pressure on his cash flow. and that is why it is said that the claims should be settled as quickly as possible to benefit the contractor. Otherwise, if you are as an owner, if you are taking too much time to settle, contractor may get demotivated. He may lose interest in your project because he may think that he is from the losing side, he is losing lots of money. So, just to summarize, as far as extra claim point is concerned, you can understand that extra claim, if it takes very large time, a long time to settle down, it adds adversely to the negative cash flow of the contractor. It adds adversely. This is what you have to understand. Extra claim means it will take longer time to settle and the sufferer would be contractor. Why? Because he may not have accounted for this much investment or this much expenditure from his part, and so his cash flow gets affected. Now, we will move to some other points. Distribution of margin. We had discussed the impact of varying percentages of margin just a while ago. Now, we are going to discuss how the distribution of margin impacts project cash flow. Now, there are three ways, normally there are three ways in which contractors distribute their margin. One is very simple, you uniformly distribute it across all the items. For example, if you have got 10% margin on your project's item and there are 13 activities in your project, in all the activities you are going to distribute them uniformly. Then there is a margin called, then there is a distribution called front loading. In front loading, what happens? Contractors will identify those items which he is going to execute right at the beginning or maybe in the initial few months. Suppose the project is of 10 months duration, he will identify those activities which he is likely to execute in, let us say, next 4 or 5 months, beginning part of the project. Now, these activities he will try to quote or bid with a higher margin. So, suppose his net margin is 10%, for these projects, for these activities which is scheduled to take at the early stages of the project, he will quote with higher margin. Suppose earthwork, which is to be done right at the beginning, he may quote at a margin of 20%. That means, whatever is his cost, he will put 20% on it. Say for example, if 100 rupees is his cost for doing 1 cubic meter of excavation, he will put 20%, that means he will quote a price of 120 rupees. Similarly, if he finds that concreting he is going to do in the initial part of the project and it takes 2000 rupees for doing 1 cubic meter of concrete, so he may quote with a 20% margin. That means he will quote a rate of 2400 rupees. So, what is its implication? For less amount of work done, he is getting more amount of money from the client. Now, when this is the situation, you will find that your cash flow position improves. That means you are better off. right at the beginning. So this is what is called front loading. So we discussed about uniform loading, we discussed about front loading, then there is also a concept of back loading, back end loading. First one is front end loading, right. Some people call this as back end loading also. So what you will find in back end loading, contractors will try to identify those items which are supposed to be taken up at the later stages of the project, when the project is nearing its completion. So those activities contractors would try to quote at very high margin. Now normally back end loading is performed in a market situation when there is a lot of inflation. Inflation is very high. So by doing so, you will find that contractors try to earn more money through escalation. This aspect we will cover in one of the lectures. How to calculate escalation, what is escalation, what are the different formulas for calculating escalation. Escalation is basically a mechanism to account for the increase in prices of material, labor and POL, which is petrol, oil and lubricants. So there are different ways through which people account for escalation. This we will see in one of the lectures at a later date. Now here also I wanted you to see the impact through a live example. So for this I am going through the same example which I have been telling you throughout the throughout this particular session, that is project cash flow example. And for that I have, since the table is long, what you can do is you can note down these column numbers, because the table which I am going to show you will have no description but only these numbers. For example, column number 1, it would mean serial number. You can note it down, because this will be helpful for you in reading the table which I am going to show you immediately after this. So column 1 represents serial number, column 2 gives you item description, column 3 gives you bid amount in lakhs, column 4 represents total cost in lakhs, column 5 it represents uniform loading markup amount, column 6 it will show you uniform loading markup percentage. So we will be discussing about percentage and finally the amount. Column 7 it would mean front loading markup amount. Column 8 it would represent front loading markup percentage. Column 9 it would indicate back loading markup amount. And finally column 10 will show you back loading markup percentage. These things you please note it down, because the table which I am going to show you now will not have these descriptions, rather I will go with column 1, 2, 3, 4, 5, 6, 7, 8, 9 and finally 10. This is just to increase the visibility of the slides. I have come up with this method in which I am going to give you the nomenclature of all the columns, and when I show you the table, actual table, you have to deal with such nomenclatures, right. Have you written it down, technology class? Please write this. I will read it out once again. Column 1 indicates serial number, column 2 indicates item description, column 3 indicates bid amount in lakhs, column 4 it represents total cost in lakhs, column 5 it is uniform loading markup amount, column 6 uniform loading markup percentage, column 7 it is front loading markup amount, column 8 it is front loading markup percentage, 9 and 10 are corresponding to back loading. Now I move to the actual table. So here you can see first row gives you column 1, 2, 3, 4, 5, 6 up to column 10. Now for the same example which we discussed in the previous lecture, I have performed the analysis in which the 3 cases of uniform loading, front loading and back loading has been explained. So column 1 is serial number 1, earthwork in all the soils, right. Column 3 gives the total bid amount which is 5 lakhs. Column 4 is cost, total cost, which if you remember we had assumed 90% of the value. So 90% of 5 lakhs becomes 4.5. Now this 0.5 is what? Margin. It is nothing but bill value minus, that means column 3 minus column 4. So the total markup or margin is 0.5. Now in first case I have assumed a markup which is uniform. What you find, 11.11 is the markup percentage. So in all the activities I have performed this, I have used rather this 11.11 percentage. Whereas if you see the column 7 and column 8, column 8 I have shown it with bold face letters and it shows 22.22%. This is the markup percentage I was telling you. Now what you find, I am quoting it at double the margin in case of uniform loading. So this is what is called front loading. So front loading means a situation in which I am keeping a very high margin for those activities or for those items which I am taking up at the beginning of the project. Now just see at the column number 10, it is showing 5.56, which is lesser than 11.11. That means for the initial items or the items which I am supposed to take up at the beginning, I have used a lower margin. So this is a situation of back end loading. You will see that when you go further down these slides, you will find that in column 10 for later items the margin would be changing. So for later items you will find that we will be using higher margin when compared to uniform loading. In uniform loading what happens? For all the items you are keeping a constant margin or constant markup. In front loading what happens? For those items which you are taking up in the beginning of the project, you are putting higher margin. For example, item number 1, earthwork, I have kept 22.22. Item number 2, I have kept 13.89. For item number 3, which is formwork, I have kept 18.52. Now, this process I have continued further for other activities also. For reinforcement, for example, I have used a markup or the margin of 12.84. For brickwork, I have used 15.36. Now, if you see item number 6, plastering, you find a very high markup in column 10, 22.59, because it is expected that plastering will be taken up at the later date when the project is nearing completion. So, in back end loading, you can notice that we have increased the margin percentage. So, this is what you have to note in this particular slide, whereas if you notice column number 6, you will find that margin remains constant, 11.11%. Clear? The same thing continues for balance activities also. Activity 8, 9 and 10. You find that in column 10, you are getting a margin or markup of 14.14%. One thing you might have noticed that I am frequently changing between margin and markup. There are certain differences between margin and markup, which I will take it up at a later in some later lectures. Right. So, for the time being, do not worry about the terminologies which I am using, margin and markup. Right now, you assume that both are same, although there are certain differences between these two terminologies, which I will take it up in some other lecture. Now, for aluminium work, which is item number 10, you find that 20.58% has been used. Here also you must find that it is at a very high margin when compared to uniform loading of 11.11%. Now, if you see the remaining 3 activities, for activity 11, you find in column 10 a very high margin of 19.05% has been used. For road works, again a high margin of 20.83% has been used. Now, when you come to the last line, last row of this table, you find that total bid price is 500, total cost for the contractor is 450. So, the net margin or net profit is 50 lakhs. This all 100 for all the item markup percentage is given 100% and markup amount is 50 lakhs. Now, in all these 3 cases, you find that whether you are doing uniform loading, front loading or back loading, the total margin that you are making is same 50 lakhs, but the timing changes. In uniform loading, this 50 lakhs you will be getting on, you will be going on getting throughout the project, whereas in front loading, higher value of money you will be realizing right at the beginning of the project, whereas in back end loading, higher value of money you will be realizing at a later date when the project is nearing completion. So, this part you have to understand it very clearly. Since the timing changes, timing of the receipt of money changes in these 3 arrangements, it makes rather big impact on the project cash flow. This aspect we will cover it when we discuss in detail the time value of money, the present cost, the annual cost, and maybe the rate of return. This point, the timing of different cash receipts will be more clearer at that point of time. Now, there are 2-3 more factors which affect project cash flow. This we have already covered. Certification type, for example, over measurement. Over measurement and under measurement, they also play certain role. Over measurement, basically it is a device through which the amount of work that is certified in the early months of a contract is greater than the amount of work done, right. There are few more things, over measurement, under measurement. These things we will be covering up in next class, and then we will have to also cover the application of project cash flow. We will see what exactly is derived out of drawing of these project cash flow diagram in next lecture. So, if you have got any doubt related to whatever we have discussed, you can ask me now. And what I am going to do as far as these lecture materials are concerned, I will be sending it to your instructor's email ID. So, you can contact your instructor, local instructor there, and get a printout of it, so that it becomes more clearer to you, because some of the slides may not be that clear to you when you see it on the screen. So, it will help you to take the printout and then come to the class, and for this you can contact your local instructor, because in a day or two I will be sending these emails to him. Technology class, you have any doubt? Technology class, you have any doubt? Okay, then if you have any doubt, we can discuss it in later classes also. And at this point, we will be closing this particular class, this particular lecture. Thank you and good night.